Welcome to Arcade. In today's video, we're diving into the 5 essential stock market Greeks: Delta, Gamma, Theta, Vega, and Rho. Understanding these Greeks is crucial for mastering options trading and making more informed decisions. Whether you're just starting out or you're a seasoned trader, these concepts will help you manage risk and fine-tune your strategies. Let's jump right in, but first, let's talk about what exactly are the Greeks. So, options trading explains the key to risk management. The Greeks help you measure risk and potential profits in options trading. It allows you exactly what you're entering and what you know is going to happen when you enter. They show how different factors, price movements, time decay, volatility, and interest rate affect that options value contract. They're used by traders to manage risk and optimize strategy. However, this isn't a guarantee to help you trade, but it is guaranteed to give you a small upper hand on what you're trading. Exactly know what you're trading with and how. First up, we're going to talk about Delta. This measures how much an option's price changes when a stock price moves by $1. For call options, Delta ranges from 0 to 1. Meaning the option's value increases as the stock price rises. For put options, it's the opposite. Delta is negative, ranging from 0 to -1, so the option gains value when the stock price drops. In our example, delta is 0.3116. You can see that on the bottom of this slide. That means for every $1 increase in the stock price, the option price will rise by 31 cents. Since delta is positive, it's a call option. Delta also gives us an estimate of the probability that the option will expire in the money. Here, a delta of 0.3116 suggests there's about a 31% chance of the option being profitable at expiration, or however, in the money. Traders use delta to gauge risk and anticipate how their options will react to the stock movements. So now that we went over delta, the next Greek, Theta. Theta is one of the most important Greeks for option traders, in my opinion. It tells us how much an option loses value every day due to time decay. Since options have expiration dates, their value tends to decrease over time, especially if the stock price isn't moving in a favorable direction. In this example, Theta is negative 0.5600, meaning that this option loses 56 cents per day as time passes, assuming all other factors remain constant. Since Theta is negative, it's a disadvantage for option buyers, but benefit for option sellers. If you're holding an option, Theta is slowly eating away at the option contract's value. Understanding Theta is essential for trading on short-term strategies or those selling options to take advantage of time decay. Next up is Vega. Vega measures how much an option's price changes with implied volatility. When volatility goes up, option price rises. When volatility drops, option price falls. Options with high Vega react more dramatically to changes in volatility. In this example, Vega is 0.0291, meaning if implied volatility increases by 1%, the option price will go up by 0.02 cents. 0.0291 cents to be exact, but we're just going to do 0.02 cents. Options on volatile stocks or during events like earnings report tend to have a higher Vega. Traders use Vega to decide whether to buy or sell option based on expected volatility. If volatility is expected to rise, option buyers benefit, but if it's expected to drop, option sellers take advantage. Next, for a fourth Greek is Gamma, rate of change of delta. So this goes hand in hand to delta. This measures how much delta changes when the stock price moves. In other words, Gamma tells us how stable delta is. This is a little confusing, but as you invest, as time goes on, you will understand it a little bit more. A higher Gamma means delta can change quickly, making the option more sensitive to price swings. In our example, Gamma is 0.1262. This means that if the stock price moves by $1, delta will increase or decrease by 0.1262. Options closer to expiration usually have a higher Gamma, so their delta can shift dramatically in a short time, meaning you can make money or lose money in a shorter time. Traders watch Gamma closely because it helps assess the risk of their position as the price of the stock goes up or down. And finally, for our fifth Greek symbol, we have Rho. This measures an option's sensitivity to interest rate changes. While Rho has less immediate impact for most traders, it becomes more relevant for long-term options. In our example, Rho is 0.0004, meaning if interest rate increased by 1%, the option's value will rise by 0.004 cents. Call options typically have a positive Rho, meaning they increase in value when interest rate rises, while put options usually have a negative Rho. Rho is less important for short-term traders, but can be a key for those trading leaps options or navigating. Rho is less important for short-term traders, but can be a key for those trading leaps options or navigating shifts in interest rates. In my opinion, Rho isn't the most important one, but it's good to keep an eye out if you're trading during those interest rate times. Real quick, we're going to do a summary of the Greeks, summarizing all 5 Greeks, and I put a table there for you guys to look at, but let's quickly recap. Delta measures price sensitivity. Key takeaway of this is higher delta, greater price movements. Gamma measures delta's rate of change. Higher gamma equal more volatility. Theta measures time decay. Option loses value daily. So every day that you hold that options contract, it will lose a little bit of the price. Vega measures volatility sensitivity. Try saying that 5 times fast. High Vega equal more impact from IV changes. From IV changes. Rho measures interest rate sensitivity. Only impacts long-term options. So if you're trading day trades, you do not care about Rho. Simple as that. But by understanding these Greeks, traders can manage risk more efficiently and make smarter trades. More calculated trades, to be exact. So you wouldn't, for example, you wouldn't do a trade or buy and sell an expiration date contract within the week and hold it for more than 1 or 2 days, because then you're losing money on just by holding it. Even if the stock goes up, you're still losing money if you're holding it by Theta. And this could be a lot of money as well. So you guys got to keep an eye out for these Greeks. That's all. I tried making this video as quick as possible. Thank you guys so much for listening. Thank you guys so much for joining in. If you found this video helpful, make sure to like, subscribe, and hit the notification bell so you never miss out on future trading insights. It means a lot that you guys made it this far in the video. And if you want real-time market analysis, trade alerts, and discussions with experienced traders, please join our free ARCAD Discord community. It's only free right now, and it will change. The link is in the description. Also, if you can tell, these are some of our profits within the group by one of our experienced traders, by multiple experienced traders. So please take advantage of that. Again, see you in the next video. Take care, guys.